This is Channel 2 Boston, public television in stereo for New England. Local broadcast of Wall Street Week is made possible by grants from Interactive Data Corporation and its Active Investor Series, sophisticated software for investment research and portfolio management designed for the individual investor. The Putnam Management Company, manager of the Putnam Mutual Funds, which are available through investment dealers and serve the full range of investor needs.
And by a grant from Bank of New England, offering discounts on full-service brokerage commissions with a Bank of New England discount brokerage account.
Wall Street Week with Louis Rukeyser. Brought to you by this and other public television stations. And by grants from the Hilton Hotels Corporation, America's Business Address, and Conrad International Hotels, a subsidiary of Hilton USA. Competition makes American business excel. Prudential Bates Securities, an investment firm with rock-solid resources that's leading the way to the future for investors. And the Sperry Corporation, providing high-technology, computer-based system solutions to the complex problems of business, industry, government, and national defense. Produced Friday, September 20. Our panelists are Eddie Brown, Frank Cappiello, and Gail Dudak. Tonight's special guest is Jeffrey Weingarten, Vice President, Goldman Sachs & Company.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, the new television season is just getting underway, that annual American triumph of hope over experience. And so the U.S. economy, which could certainly stand some better ratings itself, dutifully checked in this week with a number of possible hit dramas, quiz shows, and sitcoms. There was, for example, International Red. In that one, a popular country that has stayed ahead on its debts with other nations since 1914 slips back into the red in a series of silly foul-ups. Lots of chuckles, as nobody really pays much attention, and a bunch of highly improbable politicians pretend not even to notice. Lovers of family humor might also enjoy That Old Gang, in which a group of fun-loving oil-producing nations reminisce about the good old days when they could raise prices whenever they wanted and provided jobs for forecasters of catastrophe all over the globe. In this week's hilarious installment, the hero, Big Sorty, announces his intention to cut prices and increase production, no matter what Kuwait and J.R. Ewing want. Guaranteed laughs by the barrel. Those with even livelier imaginations will want to watch Fantasy District. In that one, the big joke is the contrast between the economy, which has been limping along this year, and even in its best yet third quarter, is now estimated to have only 2.8% growth, and the sunny optimism that continues to emanate from the Reagan administration, which insists, without even cracking a grin, that we're actually taking off faster than a Saturn rocket. As an additional feature at the end of each episode, everybody in the audience gets to guess whether anyone in the White House is really serious about those forecasts. Those of a more lyrical bent may prefer Beautiful Balloon, in which the nation's money supply grows thrillingly from start to finish, far surpassing the estimates of the sponsors. Or perhaps you'd like that new mystery show, Washington Vice. A man who hadn't been heard from in years surfaces unexpectedly in the nation's capital, claiming to have spent those years as Vice President of the United States. he makes no further substantive comments for the remainder of the half hour, thereby convincing skeptics that his claim is accurate. Wall Street fans might find amusement in that clever new sitcom, Nervous Nellies, in which everybody sits around waiting to see if anyone else is going to jump. Or in Saving Grace, in which the nation's savings rate falls to its lowest level since the Commerce Department started keeping records. And side-splitting politicians react by proposing changes in the tax code that would further encourage consumption. But if none of that's to your taste, you might wind up watching Program of the Week, in which a crafty group of institutional investors, played by Robert De Niro, Chris Christopherson, and Lassie, work out ever new programs to disrupt an orderly market and make themselves a fast nickel. It's not true, though, that it will be sponsored by DeLorean Motors. And who says there's never anything good on television? We tonight will look at other addictions in the company of an expert on tobacco and beverages. But first, let's tune in to the dropouts in Wall Street. And as the Dow Jones Industrial Average indicates, the stock market declined for the third week in a row, with the Dow dipping below 1,300 for the first time in 3 months, finishing down nearly 10 points at 1297.94, its lowest since June 19th. And there was similar erosion in the broader market indexes, with the American exchange trading at its lowest level since January. Speaking of which, looky here. Our elves have pushed their technical market index into plus territory, though just barely, for the first time since January 18th, when the market was looking a heck of a lot healthier than it does today. Which means either that it's going to be a brand new season for the elves, too, or else that they've just been watching too much television. Not that there was much else to stir the blood this week, with gold and silver barely budging, and the U.S. dollar trailing off amid fears that the economic reports would come in stronger than they actually did. Seekers after silver linings might conclude that the sluggish economic growth could lead to lower interest rates. Frank Cappiello, what are the chances of that?
Well, I think that's probably the possibility that we considered next week. With a slower growth than estimated, the Federal Reserve now has a lot more leeway. They can pump out additional money. They don't have to worry about incipient inflation or anything else.
Frank, it wasn't so many weeks ago when you fellows were telling me that the Fed was about to drop the other shoe and cut the discount rate again. Is that now a possibility?
I think it's a strong possibility now, yes, yes. The Federal Reserve wants, more than anything else, to keep this economy moving. And now is the time to give it a jolt, a shot, to get it moving. We're growing too slow.
Still, people are selling a lot of stocks. Why?
Well, one of the reasons this week, Lou, was the unwinding of options, the indexes, and so the contracts...
The program of the week.
That's right.
Stock index futures and options expire the same day, happens
exactly.
4 times a year.
That's right. And, you know, when you look at the market, it's surprisingly little damage was done with this unwinding. But the market's overdue for a rally. It's really oversold, and I would think we get something moving up next week. How long it will last, we don't know, but I think you'll get a bounce next week.
Gail Dudak, Frank Cappiello makes fun of technicians, but he sometimes gives us some technical analysis. You do it for a living. What do you make of the market's technical condition?
Well, I disagree with Frank a little bit here. I'm very bullish long-term, but short-term, I'm still a bear. I've been a kind of a short-term bear for a while. And as a technician, I look just really at supply and demand. And the thing that bothers me is that for most of this year, as the Dow has gone to new highs in price, the volume has been contracting. And that basically says that fewer people are actually buying stocks at higher prices. And so there's not enough demand here at this level, I don't think, to give us a good rally. So I'm looking short-term for down.
Would you be selling stocks? Is there going to be time to take advantage of this?
Yes, in some cases. I don't think the market is uniform. And what I saw in the last 2 weeks was that some of the stocks, like the depressed technology stocks, which I thought would hold up better than they did, were even hurt. So, yes, I think we're going to have a panic sell-off ahead. And I would raise some cash. I think that, you know, 3 months from now, that it may even out. We may be right back where we are today. If you're a short-term player, the answer is yes. If you're a long-term player, the answer is probably no time to sell.
Well, we can make a market right here. You can sell them to Frank.
How about
Ed Brown, you have the casting vote here.
Okay, she can also sell a little to me.
Okay.
Who was that great sage that said that the market makes big moves on fear and greed? Perhaps it was you, Lou.
No, but I will.
I don't think we have either at the moment. I think we really have malaise, and I think that's the problem with the market. I wouldn't expect the market to do very much on the downside. I guess the posture that one takes really depends on what you're good at. You know, if you're good at trading, I would agree with Gail, this might be a time to lighten up and try to come back later. I'm not very good at that. You could put your head in a hole, wait for the last grenade to go off. I'm not sure when that's going to be, and I don't think it's wise to try to play that game. I'm going to stand up, be exposed, but pick very selectively.
What do you think might get the market out of its malaise?
I think the problem is there are no great ideas. There seems to be no group that's moving, and there are not a lot of table-pounding ideas from Wall Street. People are just kind of uncertain, sitting and waiting for some good news, and we haven't had a lot of good news.
Well, stay tuned. Maybe we'll see later in this program. In any event, it is time now to provide blood transfusions to wounded viewers. Frank Cappiello, Gary Levin of Glenview, Illinois, is an accountant who would rather be a stock analyst for a brokerage house.
Good man.
How do you get those jobs, and what is the best way to prepare oneself?
Okay, well, Gary already has a leg up because the language of finance is accounting, and he has a good accounting base. What he needs from here on in is some knowledge of the economy and some knowledge of the stock market, and he can acquire that either going to school or reading. But he makes a start by going with a stock brokerage firm or going with a bank. My choice would be to go with a bank and get on a training program with a large bank, and after a couple of years he can make the transition as a stock analyst, as an investment officer. The harder way, but interesting, the way I started is to go with a stock brokerage firm. You start at the lowest level as a registered representative in the trenches, so to speak, and after a couple of years you work your way up. Interesting, and I applaud his motives.
It's sort of the new Gauguin.
Yes.
Gail Dudak, a number of viewers are curious about how the same stock can be listed as having so many different so-called values. So for the benefit of Michael Herzog of Rochester, New York, Frank Burns of Rockville, Maryland, and some others, would you give us a nice, simple explanation of the differences between par value, book value, and appraised value? And tell us which one you would generally pay the most attention to.
Okay. Par value is really a legal term at an initial offering of stock, and it has, I think, no real, after that, it has no value. I would forget about it. Book value is an accounting term, and it is determined by taking equity, adding retained earnings, and divide it by the number of shares outstanding. From my perspective, I like to think of it as total assets minus liabilities divided by the number of shares outstanding, and it's a Wall Street term. And usually when stocks trade below book value and the market trades below book value, it's a good buy. Appraised value is not a Wall Street term, and it's fairly straightforward. It's the fair market value of a stock. And sometimes the books don't reflect the real value of, let's say, real estate. And that would be the most important. However, it's not readily available.
Thank you for a valuable response. Ed Brown, Elizabeth Smith of Oceanside, California, is a fan of video cassette recorders because, she says, I do not care for movie theaters or people chewing popcorn in my ear. She wonders whether VCRs are just a fad that will fade, like the video games before them, or whether there are long-term investment opportunities here. What do you think?
I don't think it's a fad. I think they're here to stay. There are two ways to play it, hardware and software. On the hardware side, you have manufacturing companies like Matsushita, Hitachi, Sony, and you have the electronic retailers like Circuit City Stores, Crazy Eddie's, and Federated Group. On the software side, you have video retailers like Warehouse Entertainment and Sound Video, and you have video publishers and distributors like a soon-to-be public company, Vestron. Now, there's good news and bad news. On the hardware side, the good news is sales have been phenomenal over the last few years. The bad news is there's an inventory glut, demand is softening, prices are declining, and the retailers are expanding like mad. I would stand back, wait for things to shake out on that side. On the software side, if I had to have my arm twisted, that's where I would be, but I think the prices are rich.
All righty. Now, if you would like to fine-tune your financial picture, or just get a beta image of your future. We'll try to fast forward you to VHS, very happy success. So eject your questions to us here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Live or on tape. Now, before we meet tonight's special guest, let's take a nostalgic look at the areas he covers, beverages and tobacco. Two American industries where clearly things aren't what they used to be. When it comes to soft drinks, for example, there was a time when the leading seller had a much surer sense of its own identity, as this commercial from the late 1950s suggests.
There are times every day as you work or you play when a pause would be welcome to you. And it's then that you find the bright thought in your mind that only a Coke will do. 50 million times a day, at home, at work, or on the way, there's nothing like a Coca-Cola, nothing like a Coke.
Nothing. Except maybe new or classic or cherry. And speaking of areas where they don't make commercials like they used to, I'm happy to report the tobacco industry has had to cope since 1971 with a ban on all cigarette commercials, which means we're no longer exposed to the kind of opus that was routine 3 decades ago.
Light up, it's light up time. Be happy, go lucky, it's light up time. For the taste that you like, light up the lucky strike right now. It's light up time.
And no, kids, the real ones never did dance. But as tobacco takes on a darker identity, and Coke tries to figure out what its identity is, how are investors making out with smoke and Coke? For comparison, stocks in general, as tracked here by the Standard & Poor's 500 stock index, have managed a net gain of just 11% since the end of 1983. And the performance of the tobacco stocks has been even less breathtaking, with the S&P composite index of 3 big tobacco companies up just 8% in that time. But the beverage stocks continue to bubble. The S&P index of brewers stands a frothy 25% above where it began 1984, while the soft drink stocks have carbonated to a 37% increase. Should investors remain on a liquid diet? And will the tobacco stocks ever start smoking again? For some thoughts on that, let's go over now and meet tonight's special guest, Jeffrey Weingarten. Jeff, welcome. Delighted to see you. Jeffrey Weingarten came to Wall Street in 1971, the year tobacco commercials were banned. But that hasn't stopped him from making a very profitable habit out of America's continuing addictions. He has covered the tobacco and beverage industries ever since, first at Wertheim & Company and since 1977 at Goldman Sachs, and he has been the #1 rated tobacco analyst for the last 9 years running. Jeff, the evidence seems to mount every year that smoking is bad for people. Does the tobacco industry really have any kind of a long-term future?
I think it does. Despite the evidence that you suggest, cigarette consumption really has not declined very much.
Why?
Well, there are a number of reasons. I think the demographics play a role here. The peak smoking age is 35. The population is moving up in that direction. So even though the number of people smoking hasn't been increasing, the amount they smoke has been.
Is there a defiance here in that those who smoke smoke more?
I think to some extent, I think the fact that the tar count on cigarettes has been reduced has somewhat promoted that.
Despite what you said, the tobacco companies seem to be making an effort to diversify away from reliance on tobacco earnings.
I don't think it's so much an effort to diversify. I think they have a high-class problem of they generate a lot of cash, which really can't be reinvested profitably in the tobacco business, so there are other opportunities for them to reinvest.
So you think from here to eternity there'll be plenty of smoking done?
I don't know from here to eternity, but I think certainly for the next several years, the smoking and particularly the profitability of the industry will continue to increase.
What do you think of the companies there and their stocks?
Well, I think the stocks, as you suggested, have generally underperformed the market, and there are at least 2 that I would be buyers of today. Philip Morris would be one, and BAT would be the other.
Why do you like those two?
Well, I think certainly the financial characteristics of those companies are not really reflected in the stock prices. For example, in Philip Morris's case, the earnings growth has averaged 18% over the last decade. The dividend growth has averaged 24%, and return on equity is 20%. All those figures are well in excess of the market averages, and yet the stock is selling at the lowest price earnings multiple that it has in 15 years.
Would you sell any tobacco stocks now?
No, as your numbers suggested, there aren't any great excesses in the industry. The industry as a whole is generally underperformed.
Jeff, there are a lot of cynics out there after the last 10, 15 years in America. I guess we can understand why. But a number of them have written me and said I was terribly naive because I reported the Coke thing straight and didn't report that Coke planned it all the time. What is the story on that?
I don't believe Coke planned it all the time. I think, as the chairman suggested, he wasn't that smart and he wasn't that stupid.
What do you think of Coke now as a stock?
Well, I think that beverage stocks, generally speaking, have done fairly well over the last year and a half. As your numbers suggest, there's certainly a lot of uncertainty with all the moves that Coke has made, and uncertainty generally doesn't result in good stock price performance.
Is Pepsi a better bet? PepsiCo?
I think, again, the industry as a whole has been thrown into this sort of turmoil, and I think in that kind of environment, the stocks are not going to do terribly well.
So you're not too hard on the soft drinks. How about the brewers, since we also included them?
I think they're, in some cases, there are better opportunities.
What's happening with light beer and with low alcohol beers? Are they taking over?
Well, light beer is now about 20% of the market. 10 years ago, they didn't exist. Low alcohol still has not found its niche, really, in the consumer.
Are people drinking less of the conventional beers?
They're drinking about as much of the conventional beers. They tend to drink more, have been drinking more of the imported beers, although imports now still are only 3% of the market.
These areas, of course, overlap, but who do you like among the brewers?
Anheuser-Busch, which is the largest brewer in the United States, and Heineken, which is the largest brewer outside the United States. Those are the two stocks I'd be buying.
I think it's time to drink to the panel, starting with Frank Cappiello.
Thank you, Lou. Jeffrey, one of the reasons, at least I suspect, that tobacco stocks, particularly Philip Morris, is undergoing pressure, is selling as low as it is because of the potential cigarette liability suits. How do you assess this for an investor who wants to buy Philip Morris or R.J. Reynolds or any of the other stocks?
Well, the suits aren't exactly new to the industry, as you probably know.
The news is, though.
Well, the suits have been around. I don't know that the law has changed as much as mood and attitude has, and certainly that has affected the stock prices. But I think for the most part, since it's generally well known, it's been reflected in the stock prices, and the price earnings multiples reflect that.
Okay.
Jeff, and you also follow the smokeless tobacco area, and that's been controversial in recent years. Are there any opportunities there? And how do you see these stocks?
Well, I think the smokeless tobacco areas are now going through the same sort of controversy the cigarette stocks did 20 years ago. And over that period of time, cigarette stocks multiples have come down. I think for the smokeless tobacco areas, they're about to begin that process.
Jeff, let's come back to the diversification question again. I'll play the devil's advocate. If I want to own a food company, why shouldn't I just go out and buy a food company? Does it make sense for many of these companies to diversify into areas like that? Is the investor getting the best out of it?
Well, I think so. I think the marketing skills, the financial strengths cigarette companies have are applicable in many cases to the food industry.
Jeff, do you smoke?
Cigars, occasionally.
You have 3 kids. What do you tell them about smoking?
The decision will be theirs.
One of the decisions the country has to make is the tax on tobacco, tax on cigarettes. In several weeks, the 16-cent a pack tax is going to expire, or at least is supposed to be cut. Now there's talk about either cutting it, keeping it the same, or increasing it. What do you think is going to happen?
I think they'll maintain it at the 16-cent level.
What will that be the economic impact of that?
Basically, it won't change things very much. Tobacco taxes now on a federal, state, and local level account for about $10 billion totally on an annual basis.
What do you see as the future for tobacco in this country? You said that people are heavy in the 35-year bracket. Are people coming on stream smoking as much as teenagers used to smoke?
I think the level of teenage consumption really hasn't changed very much. I think the future of the tobacco industry is not one of volume growth, but certainly one of profit growth. Pricing has been strong. Costs have been coming down. The cigarette companies themselves have generated pretty substantial productivity gains. And the profit growth for the industry has averaged better than 13% a year over the last decade. I think certainly that's going to continue for some time.
When the news that smoking might not be ideal for you first began to gather steam, the industry moved toward so-called low-tar cigarettes. What's the news on them now?
Well, low-tar cigarettes now are about half the market, and it has in the last year or so begun to flatten out at about that level.
Why is it flattening out? Are those who smoke insisting on full flavor?
I think increasingly so, particularly as the price of cigarettes goes up. I think people want more flavor for the dollar a pack they're paying.
What do you see in the way of new trends? You've mostly told us that the same old habits are going to survive, but what are people moving toward?
Specifically in tobacco?
Tobacco and beverages.
There's within the tobacco group, as I said, they seem to be moving back towards the full flavor. Soft drinks, particularly with what's happened with Coke, you're seeing a lot more segmentation. Not only Coke, but Classic, Cherry Coke, and probably a lot of other brands under that umbrella. In the beer segment, the continuation of the large companies continuing to dominate the industry.
Just this week, I read an article as to whether new or old Coke was going to be the winner, and the answer was nobody knows. Do you know?
I don't know which one is going to be the winner. I think ultimately new Coke will be a successful product, as will Classic Coke. I think the real question for Coca-Cola is whether or not all of those brands will generate more volume than any one would have alone. And I think the answer clearly is yes.
And in the end, that's a positive for the company?
Clearly is a positive for the company.
Thanks very much, Jeffrey Weingarten, for a most interesting late summer discussion of some of the things that kept a lot of people going during this season. Thanks to our panel. And I hope you'll be back with us again next week when I'll be talking with one of Paul Volcker's toughest critics. He's Alan Meltzer, a veteran economist who maintains that many of the country's problems could be solved if only the Federal Reserve would change its habits. For all those fed up with the Fed, it should be a lively evening. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been brought to you by this and other public television stations and by grants from the Hilton Hotels Corporation, America's business address, and Conrad International Hotels, a subsidiary of Hilton USA. Competition makes American business excel. Prudential Bates Securities, an investment firm with rock-solid resources that's leading the way to the future for investors. And the Sperry Corporation, providing high-technology computer-based system solutions to the complex problems of business, industry, government, and national defense. For a printed transcript of this program, send $2 to Transcripts, Wall Street Week, Owings Mills, Maryland, 21117. That's $2 to Transcripts, Wall Street Week, Owings Mills, Maryland, 21117. Maryland residents, please add 10 cents sales tax. Wall Street Week transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week is produced by Maryland Public Television, which is solely responsible for its content.
Local broadcast of Wall Street Week is made possible by grants from Interactive Data Corporation and its Active Investor Series, sophisticated software for investment research and portfolio management, designed for the individual investor. The Putnam Management Company, manager of the Putnam Mutual Funds, which are available through investment dealers and serve the full range of investor needs.
And by a grant from Bank of New England, offering discounts on full-service brokerage commissions with a Bank of New England discount brokerage account.